Have you ever looked at your bank account balance and felt proud of that nice fat number staring back at you? You probably think that hoarding cash is the ultimate sign of financial responsibility and safety. But the uncomfortable truth that your bank desperately wants to hide is that keeping too much money in your savings account is actually a financial trap, quietly stealing your wealth. While you sleep peacefully, inflation is working the night shift, systematically reducing the purchasing power of every single dollar you have saved. Most people call me crazy when I say there is such a thing as having too much money in the bank because we are brainwashed to believe cash is king. But keeping excessive cash is financial suicide in slow motion, eroding your future freedom day by day. You were taught to associate a large cash balance with discipline, maturity, and control. You were taught that if your money is visible, if it sits in a clean digital row inside a savings account, then it is protected. You can open an app, see the number, and feel temporary relief. That relief is real at the psychological level, but it is often a mathematical illusion. The comfort comes from visibility, not from performance. It comes from familiarity, not from effectiveness. And once you understand that distinction, you begin to see your savings balance not as a monument to security, but as a forensic accounting of the psyche. You begin to see how financial anxiety masquerading as prudence can quietly dominate your decisions while wearing the costume of responsibility. The problem is not cash itself. Cash has a job. Cash is useful. Cash is necessary. Cash gives you liquidity, flexibility, and immediate access when life turns hostile without warning. But cash is not supposed to be your permanent strategy. It is supposed to be a buffer, not a shrine. It is supposed to protect your short-term stability, not absorb your long-term future. The moment you ask cash to perform a role it was never designed to perform, you enter dangerous territory. You stop using money as a tool and start using it as emotional sedation. You stop allocating capital rationally and start arranging it around fear. That fear feels intelligent because it speaks in the language of caution. It tells you that uncertainty is everywhere and that the only reasonable response is to keep more. More in checking, more in savings, more just in case. More because the world is unstable. More because investing feels complicated. More because volatility looks scary on a chart. More because at least the money is there. But what is there exactly? Not safety, not growth, not protection against a depreciating currency. What is there is a static number in a dynamic economy. And static money inside an inflationary system does not remain still. It falls behind. So the question is not whether you should have savings. The question is how much savings is enough before the emotion of safety becomes the economics of self-sabotage. This is where the 6-month rule matters. Not as a slogan, not as a vague piece of personal finance folklore, but as a disciplined boundary. Your emergency fund should generally cover 3 to 6 months of essential living expenses, not 3 to 6 months of your salary, not 3 to 6 months of your lifestyle fantasies, and certainly not an undefined mountain of idle cash that keeps growing because you are afraid to decide. Essential living expenses means the minimum amount required to keep your life structurally intact if your income stops. Housing, utilities, groceries, insurance premiums, medication, transportation required to function, minimum debt payments, childcare if it is non-negotiable, basic communication, the infrastructure of survival, not the full theater of your current consumption habits, not restaurants, not travel, not impulse shopping, not every subscription you forgot to cancel, not the version of life you would prefer, just the version of life you must protect. This distinction is where most people fail because they calculate their emergency fund through the lens of identity rather than necessity. You do not ask, what do I need to preserve my life in a crisis? You ask, what do I need to preserve the feeling that nothing has changed? That is a very expensive question. If your essential monthly expenses are $3,000, then a 6-month emergency fund is $18,000. If they are $4,000, the number is $24,000. If they are $5,000, the number is $30,000. The formula is almost embarrassingly simple. Add up the non-negotiables. Multiply by the number of months appropriate for your situation. That is the maximum amount of cash your emergency category usually needs to hold. 3 months may be appropriate if your income is stable, your job is secure, your health is good, and you have multiple fallback options. 6 months may be appropriate if your income is volatile, you support dependents, you work in a cyclical industry, or you simply need a wider margin. But once you have reached the upper bound that fits your reality, every additional dollar sitting there must justify its existence. Most cannot. This is where the illusion becomes uncomfortable. You look at a savings balance of $40,000, $60,000, $90,000 and think, I am safe. But if your 6-month living expenses are $24,000, then the extra $36,000 is not protecting you from emergencies. It is just sitting there, slowly being converted into less future purchasing power. You are not storing value nearly as effectively as you believe. You are storing digits. And digits are not wealth if the economy keeps moving, while your money does not. This is the silent theft of inflation. It does not arrive dramatically. It does not smash your window and empty your account overnight. It is subtler than that, which is why it is so easy to tolerate. It works like a slow leak in a financial tire. You can still drive. The car still moves. You do not notice the problem immediately. But month after month, year after year, the pressure drops. The efficiency deteriorates. The distance you can travel shrinks. And eventually you realize that what looked functional was quietly failing the entire time. Inflation is not merely a headline number or an abstract policy issue. It is the daily repricing of existence. It is rent moving higher, groceries becoming heavier at checkout for the same cart, insurance rising without asking your permission, medical costs drifting upward, fuel, repairs, services, labor, education, all slowly demanding more units of your labor in exchange for the same reality. So when you keep excess cash in a low-yield savings account, the risk is not hypothetical. The loss is not theoretical. It is happening. You may not see the subtraction in your banking app because the nominal number remains intact, but purchasing power is the metric that matters. If your account says 40,000 today and still says 40,000 a year from now, but the cost of living has risen, then you are not in the same position. You are poorer in practical terms. Not emotionally poorer because the number still flatters you, but functionally poorer because money is only useful in relation to what it can buy. This is the cognitive flaw that traps intelligent people. You see stock market volatility and interpret it as danger because the line moves. You see cash balances and interpret them as safety because the line appears stable. But volatility is movement, not necessarily loss. And stillness is not necessarily preservation. In fact, with cash beyond your emergency threshold, stillness becomes a guaranteed form of decay. You fear the visible fluctuation of investments while ignoring the invisible certainty of inflation. You react emotionally to temporary market declines while remaining indifferent to the mathematically certain erosion of a depreciating currency. That is not prudence. That is selective perception shaped by fear. You are treating what is psychologically comfortable as if it were financially superior. Now consider the opportunity cost, because this is where the damage becomes brutally concrete. Imagine you keep an excess of $30,000 sitting in a traditional savings account, paying almost nothing or something barely above nothing after taxes. You tell yourself that you can always invest later. You tell yourself that optionality is valuable. You tell yourself that waiting feels safer. But over a decade, that waiting is not neutral. If that same 30,000 were invested in a diversified portfolio and earned a long-term average return in the neighborhood of 7 to 8%, the difference is profound. At roughly 7% annual growth, 30,000 becomes about 59,000 after 10 years. At 8%, it grows to nearly 65,000. If it sits near 1%, it ends closer to 33,000. The gap is not a rounding error. It is a transfer of your future wealth into the graveyard of hesitation. You are voluntarily surrendering roughly $26,000 to $32,000 in potential growth on that one pile of money alone. Not because you were forced to, not because no better option existed, but because financial anxiety masquerading as prudence convinced you that immobility was wisdom. And remember, this is before you fully account for inflation. So the real comparison is even harsher. The low yield cash does not merely grow slowly, it often fails to outpace the rising cost of living, which means the nominal balance may crawl upward while the real value deteriorates. That is the cruelty of the mathematical illusion. You feel like a saver while behaving like someone quietly consenting to loss. You feel defensive while actually remaining exposed. You feel disciplined while leaving compound growth unused on the table year after year. The money is not dead, but it is underemployed. And underemployed capital is one of the least discussed forms of self-inflicted financial damage. The bank understands this better than you do, which is why the bank loves your fear. Your idle deposits are not idle to them. They are raw material. They gather your money cheaply, pay you very little for it, then lend it back into the economy at significantly higher rates through mortgages, credit cards, personal loans, business lending, and countless other channels. They monetize your desire for reassurance. They weaponize your fear to generate spread. While you are congratulating yourself for being conservative, they are using the very cash you refuse to deploy to earn far more than they pay you. That is their business model. They do not want you to become fluent in opportunity cost. They do not want you thinking in terms of real return versus nominal return. They do not want you asking whether your purchasing power is being defended. They want the emotional story to remain intact. Keep it simple. Keep it safe. Keep it here. Let the institution do the sophisticated part while you collect pennies and call it prudence. This is why the phrase cash is king needs to be dismantled with precision. Cash is not king. Cash is a servant. It is useful when moving, dangerous when idolized. A king commands the system. Cash sitting inert in a savings account does not command anything. It waits. It decays. It loses negotiating power against time. Productive assets command the system. Businesses, equities, real estate producing income, ownership stakes in economic activity. These are the structures that historically compound and adapt. They may fluctuate in price, but they participate in growth. They reflect productivity, innovation, earnings, rents, dividends, enterprise, and the expansion of value over time. Cash does not participate. It hides on the sidelines and calls that discipline. Wealthy people understand this at a level that is often invisible from the outside. They do not hoard cash as a permanent emotional refuge. They keep liquidity for operations, for obligations, for strategy, for timing, for resilience. But they do not confuse liquidity with wealth creation. They use cash as a temporary fluid tool to facilitate investment, to acquire assets, to preserve optionality where necessary, and to seize opportunities. They know that excess cash is not an achievement in itself. It is undeployed potential, and undeployed potential has a carrying cost. This is why true financial security does not come from staring at a swollen savings account. It comes from cash flow and active asset growth. It comes from building a system where your capital is working even when you are not. It comes from owning things that can outpace inflation instead of hiding inside a depreciating currency and hoping the world slows down out of courtesy. You may be thinking that this sounds too harsh because what if the market crashes right after you invest? What if you need the money? What if uncertainty increases? These are reasonable questions, but they are often asked from a distorted frame. Nobody is saying you should empty your accounts recklessly or gamble your emergency reserves. The point is not to eliminate cash. The point is to define its proper role and then stop asking it to do the work of an investment portfolio. Volatility is the price of admission for long-term growth. It is not evidence that growth is impossible. A diversified portfolio will move up and down, sometimes violently. But over long periods, broad participation in productive assets has historically offered a very different outcome from hoarding excess cash. When you reject all volatility, you do not eliminate risk. You choose a different kind of risk, one that is quieter and therefore more seductive. You choose the certainty of slow financial decay over the historical probability of long-term compound growth, and that is the psychological pivot you need to make. Safety is not the absence of motion. Safety is the presence of structure. If your emergency fund is intact, your debt is manageable, your spending is controlled, and your surplus capital is systematically being directed into productive assets, you are not reckless. You are aligned with reality. Reality is that money must either work or weaken. Reality is that the economy does not reward paralysis indefinitely. Reality is that the number in your account is not the same thing as the future life that number can support. Once you understand that, your behavior changes. You stop asking, how can I keep accumulating cash so I can feel less anxious? You start asking, how much cash is actually necessary, and where should every additional dollar go if my goal is genuine security? This is the tactical reframe. Real security is not a pile. It is a process. It is not the emotional high of a large balance. It is the operational reliability of a system. Can your bills be paid if income stops? Can you navigate 6 difficult months without panic? Can your capital grow faster than inflation over the long term? Can you create future income streams instead of merely preserving current digits? Can you move from defense to controlled offense? That is security, not stagnation, not hibernation, not the false holiness of underused cash. So you need to perform a simple but uncomfortable audit. Look at your savings account without sentimentality. Strip out the identity attached to it. Stop calling yourself responsible simply because the number is high. Ask what portion is serving a clear purpose and what portion is hiding from a decision. Calculate your essential monthly expenses honestly. Be ruthless. Remove vanity spending. Remove comfort spending. Remove everything that is not structurally necessary. Then decide whether your life actually requires 3 months of reserves or 6. Build that cash wall and respect it. Keep it liquid. Keep it accessible. Keep it boring. Then draw a line. Everything above that line is excess from the standpoint of emergency planning. It may still have short-term jobs if you have near-term known expenses, but if it has no defined purpose and no expected deployment, then it is not safety. It is drift. From there, the question becomes one of design. Where should the excess go? Into a diversified investment framework aligned with your time horizon, risk tolerance, and overall financial plan. Into retirement accounts where available. Into broad market exposure. Into debt reduction if the interest rates are crushing and guaranteed. Into assets that strengthen future cash flow. Into structures that work while you sleep, instead of structures that merely reassure you while inflation works against you. The exact mix will depend on your circumstances, but the principle does not change. Cash above your true reserve threshold should be assigned a productive mission. Unassigned money becomes idle, and idle money becomes vulnerable. There is also a moral seriousness to this that most personal finance conversations ignore. Your future self is not an abstraction. That person will live inside the consequences of your hesitation. That person will face higher costs, more pressure, and fewer degrees of freedom if you continue to confuse stillness with safety. When you hoard excess cash for years, you are not simply making a technical allocation error. You are rehearsing a worldview in which fear outranks evidence. You are training yourself to prefer emotional immediacy over strategic strength. You are normalizing decay because decay arrives politely, but your future does not require politeness from you. It requires discipline. And discipline here is not dramatic. It does not require genius. It requires honesty. Honesty about what an emergency fund is for. Honesty about the certainty of inflation. Honesty about the opportunity cost of undeployed capital. Honesty about the banking system's incentives. Honesty about the difference between seeing a number and owning real security. Once you become honest, the path is almost insultingly clear. A limited amount of cash protects you. Excess cash weakens you. A reserve prevents panic. A hoard prevents progress. Liquidity has value. Inertia has a price. If this feels emotionally destabilizing, that is because you are confronting a belief that may have organized your financial identity for years. You may have told yourself that you were one of the careful ones, one of the mature ones, one of the people who did not take foolish risks. But there is a point where caution ceases to be intelligence and becomes avoidance. There is a point where the refusal to invest is not conservatism, but surrender. There is a point where the safety you worship is only a story you tell yourself to avoid uncertainty, even while certainty is already hurting you in slow motion. That is the point this conversation is trying to expose. You do not need to become reckless. You do not need to become aggressive. You do not need to worship markets or pretend risk disappears. You only need to stop treating excess cash as sacred. You only need to respect mathematics more than mood. You only need to recognize that real financial adulthood is not about accumulating the largest inactive number possible. It is about assigning each dollar a role that matches reality. Emergency dollars protect. Investment dollars grow. Debt payment dollars reduce drag. Spending dollars serve life. When all dollars are shoved into the same low-yield box in the name of safety, you are not organizing money. You are anesthetizing yourself. And once you see that, something quiet but powerful happens. The anxiety begins to loosen its grip, not because uncertainty disappears, but because you finally have a framework. The 6-month rule is not just a calculation, it is a boundary against emotional overcorrection. It tells you when enough is enough. It tells you where prudence ends and passivity begins. It tells you that you do not need to keep feeding a savings account indefinitely just to feel like a good person. You need a reserve, a system, and a plan. That is all. Not because the world is safe, but because your response to danger must be calibrated rather than compulsive. So tonight, do not admire the number. Interrogate it. Separate protection from paralysis. Separate liquidity from laziness. Separate prudence from fear. If your emergency fund is already fully built, then stop pretending the excess is helping you just because it is visible. Visibility is not virtue. Stagnation is not safety. And a depreciating currency will not spare you simply because your intentions were cautious. Calculate your true 6-month living expenses tonight and formulate a plan to invest every single dollar above that threshold.